Hello, everybody. My name is Imrich Lozsi, consultant from Tools for F, and in my presentation, I will talk about impact of COVID-19 on the insurance industry. My presentation is split to three parts. The first one is briefly about the spread of the virus, then on the financial impacts for insurers, and finally on the future prospect, what does it mean for the whole industry. Spread of the virus. First cases in China, Japan, Asia. This is fairly known. And at the start, maybe you remember that it was only little concerns here in Europe, because we considered this as the local problem in Asia, which will die out soon. Nevertheless, when the global outbreak happened, we had a massive shock, which can be seen on the markets. In February, the record high markets experienced a record sharp decline in a very short time, and the bull market was over. You can see the indices, Dow Jones Industrial Average and Index of Fear. The share prices are sharply down, whereas the index of fear, the volatility index on the market, is sharply up. And also the last resorts, the safe haven assets, the gold and silver also got a big shock. So all asset classes were down in response to this shock from the COVID. On the life of the policy people and the societies, the World Health Organization declared the pandemic in March, and millions of people went under lockdowns, and the decisions of the authorities and the motivation for the people was driven by fear and uncertainty, lack of information, because sometimes we thought that we are not told the truth, and everybody was just concerned about his own life, and we ran to our houses to protect ourselves. The most imminent fear was relating to the spread of the virus, what this will mean for my life. And at this time, various projections came to our attention. I selected one, which is from the Imperial College, which shows that if there are no lockdown and the people continue to be together, then the potential for the virus is very, very devastating and big. So it will go very fast up, but short term it will go over, and there will be no second wave. But if we impose the lockdowns, then we can flatten the curve. We will have less infections, but as long as the lockdown is released and the people return to the work, the second wave comes back again. Just to compare to the numbers, which were very dramatic in the Czech Republic, end of September 2020, we are between 10 to 30 new cases for 100,000 people. This projection is by 2 magnitudes bigger. But what in this projection is interesting, that they almost exactly projected that the second wave will kick in as it kicked in now. It will be after the lockdown. We are back in the previous highs, and even the second wave is higher than it was during the first. So let's see, what does it mean for the mortality. The mortality development is similar as the markets. We've been in the period of the record lows. UK Continuous Mortality Investigation Bureau reported in March that the UK mortality is the lowest level ever. Whereas end of April, they said that there is an excess mortality caused by COVID-19, but from the real data, what they experienced, the excess mortality is much higher than it is implied by the official statistics, meaning the problem of COVID is bigger than it can be seen from the official statistics. Nevertheless, this effect fairly fast disappeared, because in June, this discrepancy between the real deaths and the statistics just diminished. So it was a one-time effect. Nevertheless, this effect still persists in many countries. Statistics from The Economist showing the excess deaths from all causes. This is the red line. And the shaded area, which is below this red line, shows the deaths due to attributed to COVID, which means that the real number of deaths is much higher than implied by the official COVID statistics, which can mean two things. One thing, the official COVID statistics don't catch all COVID-related deaths, or the people are dying also from other sources than the COVID. On the next page, it's a more recent statistics from the New York Times. This is a of the expected mortalities, which is the blue dotted line, with the increase due to the COVID season. And country by country, you can see that it's a significant increase. One interesting thing which I can point out is the Sweden. In Sweden, we didn't have lockdowns in spring, and the country was criticized for this. They experienced increase in the mortality, but on the other hand, if you can see the red line for Sweden, the current trend in the mortality is lower than it would be expected based on long-term averages, which could mean that the excess mortality which happened in the early months of this year was just attributable to those people who would maybe anyway die. Just the COVID fastened the deaths. If we looked at these statistics maybe from the longer perspective, then can explain this. None of the countries has similar experience, but let's wait and see how this will unfold. On terms of comparison of flu versus COVID-19, it's clearly seen that the flu is not COVID. This is the mortality statistics for different age groups for the last 4 years, comparison of the flu-related and the COVID-related deaths. On the left-hand side, we have the flu seasons, and on the far right hand side, it's the COVID-related deaths. And more dark the chart is, more excess deaths for a given age group. So this means that the COVID causes much higher mortality rates than the previous flu seasons. On the other hand, all these statistics needs to be read by caution, because it's a one-time effect. We didn't have anything like similar in the past, and therefore we should be cautious in interpretation, and we should put some error in our conclusions when we are relying on those data. So at this point, we are waiting for the vaccine or for the herd immunity, which should kick in when a sufficiently big portion of the population get infected. There are studies, one from Willis Towers, which says that the herd immunity may kick in at much lower infection rates than the officially believed 40 to 60% of the population. So let's how this unfolds, and let's look what does it mean for insurance companies on terms of financial impacts. The initial estimates of the financial impacts were very, very high, and I think this was motivated maybe the same way as the behavior of people. It was the shock and the fear what this means. Lloyd's of London estimated as a total global insurance industry loss for 203 billion, roughly halfway split between investment value losses and claim payments. At the same time, Willis Towers Watson is by magnitude lower. They estimated 32 to 80 billion. Nevertheless, even these numbers are extremely high. Let's look to individual companies. From the half-year reports in 2020, we can see that for different countries, different companies, the magnitude of the losses is really high. I will not comment individually, just to see that everybody comments that suffered the losses, and big losses in the magnitudes of millions. And also here an example of Generali contributed some money to a fund which was established for fighting the COVID. And on the other hand, Sun Life, which is the UK-based insurance company, said that the mortality losses for the global insurance industry are lower than it was originally expected. So this is the third light at the end of the tunnel. It's maybe not as bad as initially expected. On the reinsurer side, two examples. Hannover Re maintained the profit in half year 2020, regardless of the huge reserve increases due to the COVID. But Swiss Re reported a big loss, and as they commented, it's mainly event cancellation, business interruption, $1.1 billion loss during the first half of 2020. So results are fairly diverse. Most of the companies suffered losses, but also like a Hanover, which reported profits. It's very specific, maybe related to the specific portfolios and reserving policies at these companies. On aggregated basis, from the EIOPA report about the financial condition of European insurers, you can see that significant drops in the solvency ratios during the first quarter of 2020. Separately for life firms and non-life firms, I think this is really significant. But let's see the sources of these losses. So for these sources, valid claims, voluntary payments, and flexible terms and conditions. Flexible terms and conditions meaning that insurers paid something even if the policy did not cover the pandemic loss. We will talk about this later. Valid claims can come from various sources. We will concentrate here to life and health, travel and property. And let's see whether all these kind of claims which can come from these lines of business are really covered from the existing insurance policies. So first, life and health. If someone dies, there are only rare exclusions that the insurance company don't pay. It should be suicide or death connected to armed hostilities. Otherwise, the death claim is paid. What is maybe a good thing for insurance in this context is that the exposure on the old age groups is not as big as that could cause really significant losses. And maybe for the mortality, the biggest risk is the long-term consequences. Someone who went through the COVID, maybe its health status will be a bit of damaged, and he can come up with some health problems later. This is a long-term risk. In terms of the travel, we need a specific disruption on the policyholder and provider side, and usually the broader disruption due to ban of the government of not traveling is not covered. Nevertheless, terms and conditions apply, and also the pandemic exclusions might be included in the travel insurance policies, but I've seen also some where the pandemic exclusion is not there. So again, terms and conditions are crucial, whether to pay or not. And the last piece is the business interruption, which carries a lot of attention at these times, because of course the lockdowns meant a lot of businesses to be closed, and the first reaction of the persons who have insured their businesses to come to the insurance company and say, please, hello, pay to me because I was closed for 2 months and I'm running out of the money. Nevertheless, the business interruption is understood as the cover which triggers the claim only when the physical damage of the property occurs. And some policies contain such exclusion, therefore, but some policies not. And therefore there is a dispute if we have a policy which does not explicitly exclude the non-physical damage coverage, then what to do? And really, it's a problem because in the UK and also in the US, there are court cases undergoing on the interpretation of the policy conditions which are not clear on business interruption coverages. And on 15th of September, the High Court in the UK ruled in favor of some policyholders by saying that if the policy did not contain an explicit exclusion, then the insurance company should assume that the client is a non-educated financial professional. It's the person from elsewhere, from the business. He doesn't understand all the insurance terms. Therefore, the insurance company should pay. And what is interesting, the Financial Conduct Authority, this is an institution for customer protection in the UK. This was the institution who was driven the fuel of this court case. And the appeal now is undergoing. It will be interesting to see what will this mean for the other countries. And this is, of course, not a win-win situation. These quotes just show that the stake is really, really big. I will just comment on the last one. The EIOPA highlighted that it's very important to treat customers fairly, but on the same time, retroactive interpretation or retroactive coverages from the existing policies would ultimately threaten the solvency of the insurance companies and would undermine the customer protection. So EIOPA supported the insurance companies in this fight. In terms of voluntary payments, I would say that the most important are the contributions of insurance companies to various COVID-related funds, and this underlines their role as an industry who is here to protect people and the industry who cares about the public interest. There you can see on the slide a few examples. And apart from contributing to the public funds, which the next example shows the example of our Austrian friends, quite a lot of money, 100 million euro contributed to their clients in order to support them in the worst case. But apart from these contributions, we have also some positive development on the claim side because of the changed mobility means lower travel, less risk and less accidents. The first chart you can see is the mobility trends in Czech Republic, and a big drop on this colorful chart represents the drop in the mobility regardless of the vehicle in March, April. And this is also seen on the weekly chart of the car accidents, which mean better than expected experience from the motor business. This also was the case in other countries. In the UK and the US, insurance companies are returning some premiums to their customers because of the reduced risk in the motor policies. But this practice also poses some risks. In the GEICO give back cause in the US, the GEICO insurance company returned 15% of the premiums to their policy holders because of the reduced risk during the pandemic lockdowns, but the clients did not see that this was adequate. Therefore, they sued the insurance company, and it's interesting to see how this will unfold. On the positive note, further on, comparison of the current loss experience, which is in the left hand side of the chart, the current loss experience, this violet bar, 4.2 billion compared to the initial estimates made and illustrated by the yellow bars. So far so good, much less loss experience than it was expected before. So let's hope that this will remain the case. And the future prospects. On the future, regardless of the good outlook and the better than expected claim experience, we have some worries for the future. Standard & Poor's, warned the insurance industry that the second wave, so the first wave was okay, but the second wave could generate some capital issues for the insurers. And back in September, they said that second wave of the pandemic coupled with some catastrophic events could really mean some loss for insurers, so we should remain cautious. And the news from the Global Reinsurance Conference from October say that the opinion of the reinsurers is that the crisis is far from being over, so we should be cautious. So hopes are increasing, but still way to go because of these uncertainties. And regardless of the recent euphoria due to the reports on COVID vaccine and the better than expected results for leading insurance companies, the fundamental outlook is still uncertain, and the industry need to figure out how to respond to this. And the new risk and opportunities, how we should respond. The first one, digital delivery of services, keeping the people, if the people are at home, we should get access to them, but it's not easy because some products are only sold when the personal contact is there. We will need to see how the industry will respond to this. Clarity on wording of the insurance cover, it's just to eliminate the business interruption related losses. And the disputes, of course, because this is the time bomb for the future, and to offer new products who are flexible with the coverage and protect new risks of the digital economy, because we are working in a different way. We are sitting at home and communicating online, and then this poses a lot of risks. And last but not least, to find systematic solution for the pandemic loss insurance, because EIOPA and Lloyd's also preparing proposals that the pandemic loss and any kind of similar systemic risk cannot be covered just by the private capital, and also public partnership should be involved, and we should create a lot of funds to long-term funds for fighting the virus, because simply it doesn't seem to be insurable. And this is all what I wanted to say. Now we are posing a higher risk and bigger uncertainty, especially the uncertainty is higher because if we have a high risk, we can price it, we see whether to go in or not. But if we don't see whether the risk is there, then we are just blind, and we will need to make it visible in order to be able to deal with it. So welcome in the times of bigger uncertainty, and let's hope that the vaccine will be soon, and the insurance industry will be still here for the next hundreds of years as a protector of the customers. And yeah, let's hope in this. And I would like to wish you stay safe and healthy, and enjoy the remaining part of the conference. Thank you very much. My contact is here, and very last, special thanks to Marcela Vítkova, my colleague. She helped me to put together those resources, and the main source of our information is Insurance ARM, which is a server about insurance related issues. Thank you very much for listening, and goodbye.